Joining us now is Martin Wolf. He is the chief economics commentator at the Financial Times. He says the Fed's monetary policy under Greenspan was not the cause of the financial crisis. Martin, so glad you came into the newsroom to talk with us about it this morning.
It's a pleasure.
All eyes, obviously, are going to be on Greenspan today. I mean, many people want him to accept the blame for what happened. Henry Waxman, of course, we were talking about this October 08, essentially got Greenspan to admit he was wrong about banks not being long-term greedy. But you say that doesn't mean that Greenspan caused the crisis.
I think it's pretty clear in my mind, though, I know it's very controversial, that monetary policy did not cause this crisis. Indeed, it would be incredibly frightening if it had caused it, because we had moderately low rates, yes, for 3 years. It wasn't a huge deviation. It was certainly not a huge monetary policy mistake. The whole global financial system collapsed. So this would indicate such a disproportion. In my view, it's quite clear this was a global housing bubble causing a global overreach of banks, not American banks alone, and therefore it was caused by a global phenomenon, and that was the global savings glut.
But it's hard to not understand this point of the public that, look, everybody had free, cheap, easy money for a long time, and sooner or later, especially in the housing market, that led individuals and corporations to irresponsible behavior.
Yes, but you have to ask yourself, what was the free, cheap, easy money? The crucial thing that happened is long-term rates and long-term risk-adjusted rates fell to absolutely exceptional levels. Monetary policy doesn't cause long-term real rates. No economist would ever argue that long-term real rates and long-term nominal rates, for that matter, are caused by short-term rates in this way. What happened was a complete transformation of the global economy with an enormous savings glut, just gigantic, coming out particularly out of Asia, and this transformed market conditions. It's not a monetary policy mistake. John Taylor, in my view, is wrong on this. So
you say, though, that at the very least, Greenspan was wrong, but it sounds like more on regulation and the effect that could have on the markets.
As he himself has admitted, what he completely failed to understand, and the truth is all the regulators failed to understand, is in the conditions in which these asset prices were going up, risk spreads were compressing across the world, that people were actually taking risks which their capital could not support. And, of course, in addition, there was a great deal of fraudulent, irresponsible behavior. They relied on the rating agencies. They weren't doing their job.
Martin,
there was a system failure.
Isn't it a one-step, two-step kind of thing? I mean, if you just give access so freely, isn't it understandable that sooner or later greed gets out of hands?
Well, regulation is designed to ensure precisely that this doesn't happen. And the core regulation of the system is designed to ensure there's fundamental honesty in these transactions, there's adequate capital, and there's adequate leverage. And what was allowed to happen across the Western world was essentially financial institutions were allowed to operate with effectively no capital. In this situation, they had no capacity to cope with a crisis. It was the interaction of leverage with the asset prices that caused the meltdown, and that clearly, in my view, was a profound regulatory failure. And it was happened because, indeed, this is Greenspan's mistake. He believed that the market would ensure that the financial institutions, in their own interest, would look after the risks, and they didn't.
But arguably, all right, we saw a huge collapse in the U.S. Right now in Spain and in Ireland, those countries are suffering as well, and in part also because of a housing collapse where prices had gotten out of hand. So it seems like we're all in agreement that this is a global problem.
Yes.
But it could be made the same argument that the ECB also kept the rates too low for too long.
Well, but the ECB was nothing like as aggressive as the Fed, or was certainly not as aggressive as the Fed. And you have to remember, it's quite important to note, the ECB is a very conservative central bank, so it was clearly doing the least it thought was necessary to ward off the genuine concern about deflation. And we have actually, in my view, been running in a somewhat deflationary global environment for 10, 15 years. So that's why the banks did this.
They have a different mission.
Ultimately, I think you have to look at the global background conditions in terms of the supply and cost of savings and the risks people were prepared to take on. That's, I think, much more important than monetary policy. People are putting too much weight, in my view, on monetary policy alone.
So, Martin, just to recap here, you think Greenspan will admit to being wrong on regulation, wrong on the markets, but not wrong on monetary policy?
That's clear. He will never admit that he was wrong on monetary policy. And I know it's a very controversial view, but I agree with that.